Hello and welcome to the latest Advance Your Wealth video series. I'm Homer Smith, private wealth advisor with Convergent Wealth Partners. And today we are going to be focusing on our Q4 investment and economic themes, where we're going to cover a number of areas throughout the video today, hitting on what we saw in Q3, both from a market and economic perspective, as well as some of the key things that we're seeing in the upcoming tax legislation that we think are going to be really critical for all of you to be focused on, and some things before year end that we think you're going to want to be paying a special attention to. So with that, I'm going to start with really diving into the key themes that we saw in Q3, especially from a market perspective here on the first number of slides. So what we saw is a market that in the first 2 months of the quarter was really strong, and things were looking really good overall. But we did see some hiccups here late in the quarter in the second half of September. And a lot of those concerns, depending on what narrative you listen to, were related to whether we were going to, run into issues with the debt ceiling, some of the challenges with the budget programs that are going through Congress, issues with China, that, kind of things were all over the map in terms of some of the potential issues. But at the end of the day, effectively what we saw was a stagnant stock market, the S&P barely finishing up above the zero line, with the NASDAQ doing slightly better. But we did see some negative performance overall from the industrials as well as the Russell 2000. Some of the other things that we saw throughout the quarter was the bond market. So both quarters of the year, we saw rates rising a little bit, and then we saw a little bit of a retreat of rates early in Q3, but then they've come back in a big way, finishing the quarter just around 1.5% overall on the 10-year Treasury. Some of the other key market areas that we've been watching, and this one really closely, is commodities. So it's one that we've been overweight on all year, an area that we thought, due to rising inflation, we would see continued strong performance. And, boy, did we get that here in Q2. While the rest of the markets were kind of struggling, especially near the end of the quarter here, we saw commodities finish the quarter up over 6.5%. So again, you're hearing the inflation narrative come back quite a bit, and commodities are going to have a pretty close correlation to that. Typically, when you see inflation rising, we're expecting to see commodities do well through that as well. An area that we thought would do better in Q3 were European equities. We anticipated, with Europe seemingly about a quarter behind the US in terms of coming out of the COVID restrictions, we thought that they would have a little bit stronger performance. And, it looked that way early in the quarter, where they were, the markets in Europe were up over 4%. But with, some of the latest drawdowns here in the second half of September, European equities actually finished negative on the quarter and finished in a way that they were underperforming US equities. Another area that struggled quite a bit over the last quarter was emerging markets, but really this was in particular to China. Again, if you were following the headlines closely throughout the quarter, the real estate market in China and some of the focus from the government on cracking down on some of the issues going on there. And you probably heard a specific company, Evergrande, who was having trouble making some of their debt payments, which caused a lot of challenges in that Chinese market. So that was the primary reason for the underperformance of the commodity or of the emerging market index. Another area that we focus quite a bit on is precious metals overall, and we just watch that closely. And what we have found is that it is pretty closely related to interest rates. There's a lot of correlation there. And so when we see rising rates on the 10-year Treasury, it typically leads to struggles in some of these metals markets. And we saw that, here as the 10-year Treasury spiked here at the end of the quarter, we saw some pretty significant drawdowns, just metals market as well. So really, what did we learn through the quarter? What we learned is really what we expected to see. We were anticipating coming into Q3 that we would see some level of stagnating growth due to a resurgence of the Delta variant with COVID, and we definitely caught that. We also thought inflation was going to start playing a much bigger role in not the perception of the market, but also some of the impact in the market, and we definitely saw some concerns and some narrative around that. So, really at the end of the day, for the stock market performance, across the board, it was mostly a ho-hum, pretty flat quarter. And so next, we're going to dive more into the economic outlook, and then we'll wrap up this part with where we think things are headed in Q4, both from an economic and from a market standpoint. So diving into some of the economic data that we saw go down in Q3 or in what we kind of see coming in the near future is really this big story around inflation. And it was something that if we look back at kind of the end of Q1 into Q2, there was this term transitory that was being thrown quite a bit around inflation, that, hey, inflation is just transitory. It's due to these supply chain issues related to COVID. Once things kind of get settled with that, everything's going to return back to more normal, and we're going to see prices come down. And what we're actually seeing is that, while there's still some truth to that narrative, that there's a lot of supply chain issues that are leading to some of this inflation, I think there's more and more of a belief that this isn't transitory, that this inflation is going to be sticky. It's going to be at a higher level than people expected for much longer. And we're definitely seeing that in the data that's coming out with the CPI, Consumer Price Index, and that rate of change on the nowcast, which we're anticipating continued to rise. We did see some slowdown on the economic activity in Q3, though, with the rise of the Delta variant. And so it really slowed the momentum we were seeing in the first half of the year. So we did see slowdowns in service activity, in consumer confidence, and in some level of the service sector employment. And so again, we expected a quad 3 in Q2, which is slowing GDP, rising inflation, and that's definitely what we got in the quarter. Some of the other key things that we saw happen through the quarter is, continued improvement overall, or at least flattening out on the unemployment rate. So it's still hanging out around 5%. So, severely below where we were at the height of the COVID crisis, but also still well above where we were prior to that. And we did see the Q2 release of GDP, which was extremely strong, over 12% growth year over year in GDP for Q2. However, that was the Q2 number that's released in Q3. And so we anticipate when that number is released in Q4 for Q3, we'll actually see a pretty significant slowdown in GDP in terms of rate of change quarter over quarter. So keeping a close eye on that here in the coming weeks. Some of the other data points, again, back to the Delta variant, we're finally starting to see some peak numbers, or at least what we believe are likely peak numbers in COVID for the Delta variant, which should be positive news for the economy opening back up again here in Q4, and likely some positive momentum for GDP. We also don't think that inflation is slowing down anytime soon for a number of reasons. There's wage pressure is starting to leak into the picture. We're seeing rising income. We're also seeing a lot of the issues that people are experiencing. These supply constraints have led to a severe drop in inventories overall, whether it's manufacturing, retail, and in order to get those inventories back up, that's going to lead to positive momentum from a GDP standpoint. So looking directly into some of the forecasts from our research partners on where things are headed, again, we had over 12% GDP year over year in Q2. We anticipate we're going to see that number come in closer to just under 6% here in Q3, and then we're going to see it steady in that same area, 5.8, 6% in Q4. So we anticipate again a little bit of a flattening out, and then a little bit of a re-acceleration in GDP. And we definitely don't think that we're slowing down on the inflation side anytime soon either. We anticipate that a lot of factors, continued wage price pressures, rental price increases, and leaking into the housing sector of the inflation metrics are also going to be impactful in seeing rising inflation coming ahead. Some of the other things we're keeping a close eye on, and we mentioned inventories already. One area that you can see that almost more than any other is in car inventories. They're at near record lows. And again, as some of the supply chain issues get mitigated, hopefully here in Q4, all of those dealerships are going to have to reload their inventories, and inventory is a very large component of GDP. So we anticipate a lot of support to GDP in the coming months. We also believe that, even though the Fed continues to talk about tapering, meaning taking some of the chips off the table they've been using to support the market, we don't anticipate that they're really going to be able to do as much as they say. And so we expect, continued support from the Fed overall in terms of the economy and the markets heading into Q4. So what does this mean overall? What we really anticipate is that the things that are going to do well in Q4 are really going to be around this theme of inflation. And it's going to be inflation focused equities, in particular commodities, real estate investment trusts, those especially multifamily real estate investment trusts should have strong pricing power here in Q4, as well as typically big tech does well in a rising GDP, rising inflation environment. And again, we still believe European equities have some room to run, and emerging markets, but in particular commodity focused emerging markets, whether it's economies like Russia and Saudi Arabia that are oil focused, and some of the others out there. But we're staying away from countries like China, which we think are going to have some continued struggles here in the coming months and the coming quarters. So the last thing I want to hit on is just some of the proposed tax law changes. We released a video just here in the last week. Dave Steeling and myself put a video out kind of covering some of the highlights from these proposed tax law changes, but I just want to hit on that quickly here again, just to make sure you don't miss it, because I think there are some things that are really important that you're going to have to think about before year end. So first off, in terms of, I think the one that's probably the most urgent is some of the changes they're proposing to the estate tax exemptions. So right now, the individual exemption from an estate tax perspective is an 11.7 million exemption on your assets for an individual, and then that adds up to over 23 million for a couple. That's going to be reduced in half here at the end of the year. So it's going to be about, call it 6 million per person, or about 12 million total. So, if you, and I know that's still a lot, of an exemption, and it doesn't hit that many people. But if you're in that boat where you have over 12 million as a couple, or 6 million individually in your net worth in your estate, there's some things that you should be thinking about before the year end to take advantage of these currently much higher exemptions, to determine if there's some assets that you should be getting out of your estate. They're also changing some of the strategies we've used in the past to help clients move money out of their estate, but still have some ability to access that capital if something comes up and they need it. A lot of those strategies are going away as well. So definitely an area that you need to consider before year end. Some of the other key changes are simply an increase in the highest rate for income taxes, moving up from 37% up to 39.6%. But the biggest part of that is it's also starting at a much lower level of income than the current highest rate of 37% is hitting you at. And then in particular for high income S corporations, because it's a flow through, your income is taxed at individual or joint income tax levels. And so you're going to be moving to that top 39.6% rate. But in addition to that, they're proposing a 3.8% surtax on net investment income on your S corporation earnings. And in the past, S corporation earnings have been exempt from that net investment income tax that was introduced, about a decade ago. No longer is that going to be the case. So for high earning S corporations, your highest tax rate is going to go from 37% all the way up to 43.4% on the federal level. So pretty big increase there. And if you're a really high earning S corp, they're going to throw on another 3% if you're over 5 million. So it could be going as high as over 46% just at the federal level for high earning S corporations. Some of the other areas that I think are important to address are some of the changes they're making to the ability to do some Roth IRA funding, especially for high income earners. In the past, we've used strategies like the backdoor Roth IRA or the mega backdoor Roth IRA, where you're able to make after-tax contributions to your traditional IRA or your 401k, and then convert those dollars to Roth IRAs. Under these new tax laws proposal, they're proposing to take away that ability to convert after-tax dollars from 401k plans and from traditional IRAs. So if you have been using that strategy, you need to get those IRAs funded and converted before the end of the year. So there's a lot more involved in these proposals. And as of now, they are just proposals. We've heard from the AICPA that the goal is to pass this legislation by the end of October or by early November. So it is something that's coming. But but at this point, again, we don't know for sure what is going to be in the final parts of the bill. It doesn't mean that you shouldn't be doing some preparation for what might be in there. So hopefully you found some value in some of those ideas that we gave you here before the end of the year. So with that, this is kind of the end of the Q4 themes. I hope you got some value out of the presentation today and some ideas on things that you need to be thinking about with your portfolio and around tax planning here before year end. If you have any questions, we'd love to be able able to talk through anything in your individual situation here, please shoot me an email if you've got questions at homer@convergentwealth.com. With that, we hope you have a wonderful day, and we'll look forward to talking with you soon.